Hello and welcome to Fireside with the VC. My name is Andrew Romans and very excited to have Brad Feld on the podcast. Brad Feld, if we get into his bio, we won't be able to get into the interesting things. So let me kind of give you a little background and pay attention to the dates. I find the dates to be very, very interesting if you understand the evolution of the industry. So Brad, I think it was in Boston where you started your first company. I think that was 1985. And then exited the business in 1994. I remember it was 1993, I think, when Mosaic came out so if you were enjoying HTML, it got even better when all of a sudden you had a web browser. I think that was 1993. So at the time that Brad had exited and had cash in his pocket, decided to become a prolific angel investor just when kind of 1.0 was taking off in Unix and Sun were kind of taken off. And then I think it was, he became a managing director at SoftBank Technology Ventures in 1997. Then they kind of turned that into Mobius Venture Capital in 2001, another iconic date in the industry. And then together with David Cohen, co-founded Techstars in 2006. And I would have thought the Foundry Group went back deeper, although it's been a long time. Foundry Group, I believe, became official with Seth Levine, who's another great guy, 2007. And I think today you guys are somewhere around $3 billion of AUM, headquartered out of super cool Boulder. And I would say before the great COVID migration, it took a certain set of balls to say, we're moving to Boulder and we're going to do this out of Boulder, where now that's sort of a par for the course normal.
Yesterday's news.
Yeah, exactly. But good to get a jump on a trend. And Brad is also a prolific author, kindly contributed to 2 of my books. And, if you can only read one book and you're going into your first venture financing, I think Venture Deals is Shakespearean, timeless reading. But I've enjoyed a number of his other books. Brad, how many books, including the new Nietzsche one, have you got out?
8.
8. Okay, so I got 5 I should probably pick up. Beyond that. But I think that tweeting 63,000 tweets, without going very deep, as opposed to writing a book and getting deep into it, to me, it's more interesting. But listen, Brad, and your latest book is called The Entrepreneur's Weekly, Nietzsche, a book for disruptors. So I don't want to get too sidetracked on that, but very curious. And I've heard a podcast, but tell us a little bit about you bringing back to life the controversial figure of Nietzsche.
The book is about entrepreneurship, not about Nietzsche, but we built the book around 52 Nietzsche quotes. And the book was written with my partner in my first company, Dave Jilk. He and I have been best friends since we started that company in the 1980s. And this was the most recent collaboration that we've done. It was really inspired by 2 things. One is Dave had semi-retired and was spending a lot of time reading philosophy and going deep on individual philosophers. And he became interested in Nietzsche and started tossing Nietzsche quotes at me and saying, does that sound like entrepreneurship? And interestingly, as we talked more and more about it, it did. I'm Jewish, and I think the reaction a lot of people have about Nietzsche, if you're not terribly informed about him, which is, my first statement was, isn't he that German philosopher who was a Nazi? Which generated my own exploration to get comfortable with the idea that Nietzsche was actually an incredibly important philosopher and a deep disruptor in the context of classical to contemporary philosophy. So that was one driver. And then the other driver was Ryan Holiday and all of his work around Stoicism and Stoic philosophy and how that applies not just to entrepreneurship, but to life in general. And I'm a huge fan of Ryan's, and we're friends. And I thought what he did for bringing Stoics and the philosophy of Stoicism to the mainstream was magnificent and really, really powerful. One of my favorite books that I keep in my bathroom is a book called The Daily Stoic. And each day I read whatever the daily quote is, and then the couple of paragraphs to a page that Ryan's written, sort of contemporarily interpreting the quote. And Dave and I just decided we would try to do the same thing with Nietzsche, and we didn't feel like it was worth, torturing the world with 365 Nietzsche quotes. It seemed a little too ambitious for our taste, but we ended up doing something very similar, which is we had 52 quotes. we translate each quote from its English translation, which is of 19th century German, to English that's generally around the turn of the 20th century, because we used all open source translations. And then we rewrote it in contemporary, 21st century English. We then write a 2 or 3 page essay. And our essays were not, like a lot of entrepreneurial stuff these days. You should do this, you should do that. If you want to decrease CAC, here's how you do that. If you want your LTV to go up, here's what you do. This is how you, it's not that kind of stuff. It's much more of ideas that were provoked by the Nietzsche quote in us. And then for about 2/3 of them, we had an entrepreneur write a narrative from their own experience about what the Nietzsche quote meant to them. So it's intended as a book to read slowly and to just kind of savor and to use to provoke thought around the process and experience of being an entrepreneur and being a leader.
But it's very cool. I mean, it sounds like there's 52 cards in a deck of playing cards, but they're also like tarot cards are almost a way of getting the conversation going sometimes. Like you don't have to believe in any of it. It's just like, let's have a session where Nietzsche will start us off with this and let's see where that leads. And, with people in your network, could be fun. But let me dive into a couple questions and it'll end on perhaps the more interesting for you. But the valuation market is so different now than it was before COVID. Like you see companies that have yet to have even product raising at higher valuations, companies that have a little bit of revenue, higher valuation, and then real strong CAC to payback, CAC to LTV valuations are getting higher and higher, and maybe more crossover funds coming from the hedge fund world. But to start at the beginning, can you give us some advice on if a founder is making their first moves on setting up their new startup? What are some advice, maybe even in advance of fundraising? And then some ideas and advice on raising first outside capital from angels and then into dealing with VCs?
Yeah, well, I think in a lot of ways, the question is disconnected from the current market reality. In other words, whatever the prices that people are paying for is sort of disconnected from what should you be doing at the very beginning. From my perspective, there's a couple of key things that any founder should be focused on. One is to make sure that the thing that she is working on is something that she's obsessed about, that she was really put on this planet to work on that problem. I think the phenomena where somebody wants to be an entrepreneur or somebody wants to start a company, but they're not obsessed about the problem, is really in a lot of ways making it much more difficult to be successful, because you have to be tenaciously focused on the problem you're trying to solve. And most startups are an endless series of experiments, many of which fail. So you're constantly testing hypotheses, looking for the thing that's going to work. And when you find the thing that's going to work, then you go hard after it. But if you don't have this obsession for the thing you're working on, it's very, very difficult to stay after it. And I use the word obsession deliberately instead of the word passion, because I think passion is very easy to fake. I think passion biases towards extroverts. And there are a lot of incredible founders that don't exhibit what we would naturally call passion around something, but have very, very deep obsession about what they're working on. There are plenty of very successful entrepreneurs who are passionate as well, but that obsession is a given. So that would be piece one. Second is, it's very hard to start a company by yourself. It's possible, and there are definitely cases of successful founders, single company founders, but even many of them where people identify a company with an individual founder, often the founding team was multiple people. And, we can look at existing examples today you might identify Twitter with Jack Dorsey as a founder. But, there were 4 founders at Twitter. You might look at, a company I was involved in, which was very early on, was Zynga. And Mark Pincus is often thought of as the founder of Zynga. And Mark was the founder, but he was really the co-founder. He had a couple of other co-founders with him at the very beginning of that experience, that were not as visible as he was, but were very important to what was going on. And you can play it all the way through, right? Going back in time, if you look at Yahoo, You look at Google, those are dyads of founders. Microsoft was a dyad, between Paul Allen and Bill Gates, and on and on and on. So as a founder, like, pick your co-founders really thoughtfully and try to attract co-founders that are really additive and complementary to you. They don't necessarily have to be agreeable. They don't have to be subservient. They don't have to be equal, but just, that configuration of the small group that's the nucleus of getting started with the business. And then the third piece is surround yourself early, especially if you're a first-time entrepreneur, but it's very valid for any stage, with mentors and people who have had experience, not necessarily as founders necessarily, whatever you value their experience, wherever your blind spots are, wherever areas that you want to grow and develop are. But very early on, engage other people that you respect and that you feel like you can learn from. And one of the things to realize about a mentor dynamic is that the really good ones are bi-directional, where the mentor learns from the mentee. And the one I describe over and over again is the guy that bought my first company, Len Fassler, who passed away at the beginning of this year, but was an incredibly, incredibly powerful force in my life, both as somebody who bought my first company, as a mentor of mine, of somebody who sort of actively took me under, his metaphorical wing. I'd never bought a company. I'd never done an investment before I met Len. So I learned a tremendous amount, not just about the mechanics of things from him, but about the style and culture and approach, not just of the business and the business deal, but of how to work with people and how to think about different kinds of relationships and how to build those relationships over a long period of time. I also learned lots of stuff from him about how to deal with disappointment and how to deal with things that don't work and how to deal with relationships that end up not sustaining. And it wasn't a paternalistic relationship per se, although he was my father's age. But in some ways I felt it was paternalistic at the beginning. But, for the last 10 years of his life or 15 years of his life, I would say, if you asked me, did Len learn more from you or did you learn more from Len? I think I would say I learned more from Len. And if you asked him the same question, I think he'd say, I learned more from Brad. I mean, it was a very symbiotic, loving, deep relationship that, came out of a random meeting where, one guy was looking to buy a business and another guy had a business that he wasn't looking to sell, but he liked the guy who he met with. So I put those three things at the beginning. Like, for an entrepreneur, make sure the thing you're working on was the thing you were put on this planet to do.
Yep. Work
hard at picking and working with co-founders if you choose. Don't just randomly do it, really. Like, make it and put energy into each other and learning how to be effective with each other. And surround yourself with mentors, but don't view it as a one-way relationship.
Yeah, I think that having been through it myself on the founder side and then a lot on the investor side, this is the industry I was born to disrupt because I understand it. So if you grew up in the printing industry and you figured out how to digitize that, that's the one that you understand, or the one you could sell into, or the one you were servicing, and now adding software to eat the world around that, you're built for that. In a world of pivots and iterations, the investor is left with the industry, the team, maybe some core technology. So if you really bet on the founder from the investment side, you're dealing with team, industry, and perhaps some kernel of technology. On the recruiting, I think recruiting your co-founder or co-founders is probably the most important, irreversible decision you can ever make. And then when you get into fundraising, I think having that same mentality of everyone you bring into the orbit of your company is going to have some kind of impact, to it. And so you should have that same kind of thoughtful approach, as you build kind of a high growth impact, lasting company. With having been around for the first wave of the internet and whatever wave we're calling this, I can imagine that you see businesses that failed or succeeded when the world was very different, and maybe the timing was wrong then, or the timing is right now. when I look at Amazon, I think of Webvan, you know, like, oh, Webvan is going to be so huge that it could have been, you know, the 2 trillion, whatever, throwing people into outer space, you know, kind of company. But when you see companies, you probably have that perspective of, I saw a very similar company, and you know what? The graveyard for this whole place is huge, but maybe you can make it work. What's your perspective on triaging deals that come into your orbit, whether it's cold or through a warm intro? What are some of the first things you try to zoom into when kind of triaging a new opportunity to invest in?
Our strategy at Foundry has evolved because of some of the things that we've done since we started something called Foundry Group Next in 2016, where we started allocating 25% of our capital to other pre-seed and seed stage venture funds. And we now have over 40 of those funds that we're significant LPs, and it's not just, you know, small checks, but we're, you know, 5, 10, 20% of their fund. And we've really shifted our model to be a network-driven approach, where we're typically we have exposure to thousands of companies at the pre-seed and seed stage at this point. And then we're typically doing Series A, Series B investments into companies that existing partner funds of ours have already invested in. So from a strategy perspective, it's evolved from a intellectual perspective. For me, I've always been very focused on trying to say no to almost everything very quickly, because it didn't fit within some filter that allowed me to then focus on things I felt like I knew well. And for, you know, the first decade of Foundry, we used a set of themes that we defined when we raised our first fund in 2007. And they're pretty abstract constructs. They were things like human-computer interaction, protocol, tech companies built on technology protocols. HCI was the premise that the way the technology is going to work 20 years from now is going to be radically different than the way technology works today. We had a theme around marketplace. We had a theme around glue, which was software that connects machines to machines. And if you went back in time to the 1980s, it might have been called middleware back then. Right. And we use these as our filter. So if something didn't fit in the theme, we generally didn't spend much time on it. Today, we've expanded beyond those themes because of the way that our partner fund network works. So when I pop up intellectually, let's say that it's something that I'm going to look at. I focus on 3 things primarily. One is, do I have an affinity for the thing that's being built, the thing that's being created? Doesn't mean I have to be a daily user of it. I just have to care. And part of the reason for that is a little bit linked back to what I said earlier. I mean, companies are huge, you know, cycles of ups and downs and disappointments and things that don't work and challenges with technology and people and markets and competitors and everything like that. It doesn't matter how successful something looks in the end, that process of getting to that point was really hard. And my own experience is, if I don't care as an investor, it's hard to keep your head in it really deeply when things get all screwed up. And it doesn't matter what dimension the all screwed up is. So that affinity for the thing the company's creating is a starting point.
Which, by the way, is tying into, I think you've said, you know, passion's for the bedroom, but obsession is for what you're looking for, and that grit. If your VC doesn't really give a shit and they get behind the company, that's not the kind of enthusiasm to keep people working there when it's not about compensation or, you know, the mission.
That's right. That's right. As long as everything's awesome, don't worry about it. The second something goes off the rails, So piece 1 is that. Piece 2 is, I'll come back to the word obsession. Are the founders obsessed about what they were doing? And again, the easy way to translate that for me is, were they put on this planet to work on this thing? Maybe not for the rest of their lives, but in this moment, this is the thing that they're here to do. And then the third for me is, do they want me to be a partner with them as much as they want to be partners, as much as I want to be partners with them? So is that partnership bidirectional? Do they want me as a partner as much as I want to be a partner of theirs? And, you know, in the world where there's a lot of capital available, in a lot of ways, it's very powerful that entrepreneurs have choice, compared to, there have been long stretches of time in my entrepreneurial and investing experience where there, you'd be happy to get one offer from somebody versus a bunch of offers. And, there's the endless positioning by investors today around who adds the most value and who's going to be the best investor and who's going to help the most and this sort of thing. And, from my perspective, I view it's a very powerful, I'll come back to saying that we're powerful. It's very powerful that founders have choice. Yeah. Because it means that they can then decide who they want to have as their investors and as their shareholders with them in the company. And I like that being bi-directional, because if they don't have a choice and I'm the only one that's offering them a deal and they choose me, well, they choose me because I'm just money. I mean, they might want me for other reasons, but
or even worse, even basis points, or even, going on a basis point decision, right?
That's right. Or, if it's somebody who has 5 offers and they, they're driven by the highest price and that's what they want. They don't care that anything else. They just want the highest price. That's okay. That's probably not somebody that they didn't want me as an investor as much as I wanted to invest in them if I'm not the highest price. That's okay, right? Because from my frame of reference, I'm going to make a finite number of investments. I'm trying to have fit between me and the founders in terms of our goals and our aspirations and our desires to work together. And that then puts the onus and the burden on me for, being clear and consistent about what I do and how I do it. And the same thing with my partners at Foundry. And I think that puts good pressure on the system in general for investors to be really clear about what's happening. We're in a very positive part of the cycle right now. So, a lot of entrepreneurs, I think, especially entrepreneurs that are doing it for the first time, that have not seen necessarily bad behavior from investors, who have not gotten crosswise with investors in other companies, or, who have not had difficulty navigating certain situations. And I'll just give an example of this. In the positive part of the cycle, when you haven't had that experience, you're like, all the money's the same, everybody's the same. And the negative part of the cycle, that's when you start to really understand what people are made of, who's going to be actually working with you to try to get out of whatever ditch you end up in. And then being pragmatic about whatever the reality of the business is. I was, I would say in a negotiation with a founder or 2 founders for a company that we're ending up investing in. And sort of in that discussion, they had a couple of very specific things that they cared a lot about in the term sheet that I would say were pretty much not standard. They weren't down the middle things. They were things that were very founder oriented. And I didn't scratch them out with a red line and say, no, can't do that. I said, why? Why do you want those things? And just tell me a story so I know the history. And the history was that in a prior company, the company had gone sideways, and the CEO founder was, struggling with one of his major investors, and it's an investor who everybody would know the name of. It's a well-known, very successful, financially successful investor. And that investor basically said, look, I want to fire you. It's time to bring in a new CEO. And the CEO didn't agree. And the new investor, or that investor, didn't have enough economic right to just unilaterally fire the person. And there was resistance among other directors to fire the CEO. And, it was the kind of normal mess that unfolds. And that investor then said, well, okay, I'm going to convert all my stock to common and take over the common class based on the math dynamics of whatever the conversion was. Not just that investor, but another investor who, would side with that investor because of power. And we're going to take over the common class. We're going to kick you out of your board seats. And we're going to take over your board seats. And then we're going to fire you. And, it was kind of like entrepreneur hadn't thought that was a move that was coming. It turns out that investor didn't have the votes in the end to do that if they converted to common. So it was kind of a threat that they couldn't follow through on. In the end, the company got acquired and had a decent outcome, and probably a better outcome than would have happened if the CEO had all that disruption had occurred.
They'd gotten rid of the CEO, sure.
Yeah, and so that CEO is very, very focused on a couple of very specific things in the configuration of the deal. And my response was, you know what? I get it. I get that story. I understand it. And, in terms of me investing in you, yeah, there's some chance that things don't go well, but I'll take that chance. I'll accommodate your concern there based on what happened. As long as, we have the agreement that we can have the conversation at some point, if I don't feel like you're being effective as a CEO, and you won't say, sorry, you don't have the votes to do it. He said, absolutely. If I'm not being effective as CEO, I'm happy to have the conversation. Again, I'm willing to take that risk. I'm willing to take the risk that in that moment, the person says to me, fuck you, Brad, you don't have the votes, so good luck. But in the absence of understanding, like, I think a lot of investors don't even go into that layer with the entrepreneur, or the entrepreneurs don't consider those dynamics. One can say, well, I hear this is cliche all the time. It's different this time. It's always going to be up and to the right. Everything's always going to be successful.
You should never plan for only good weather.
Right. Whatever.
Gotta plan for some rough, choppy water.
Right. I feel like I'm the old guy now in the room. I probably am the old guy in the room. And kind of my view when somebody says that is I don't even bother arguing with it anymore. I'm like, whatever. Because through life, even in environments where everything's going well at a macro level, from a business perspective, there's always lots of ups and downs. Lots of companies aren't successful. I read today, I thought it was awesome, great idea. Some people have put together a stranded unicorn fund, and they're raising a fund to buy the venture equity for very little money to no money in companies where, it's a unicorn that, now is not working. And there's plenty of them. And we talk about the ones that are working, but there's plenty of companies that raise money at too high valuation, and early equity is worthless. And so, like, the notion that we're in whatever, I'm not going to be predictive, but the notion that understanding the character of the people who you work with, whether you're the investor or you're the founders, is really important.
Yeah, I think in a very provincial location where there's not a very evolved ecosystem, like, I don't know, south of Rome in Italy, you have like one investor and the one entrepreneur, and they're like, look, you do the work, I'll put up the money, I get half. And that'll be the final investing round for this company for between now and the end of time. And they don't realize they're rapists, but if you're the only choice, even like, we've invested in some random parts of the United States where the local VC said, hey, I think, should we be doing a pay to play now? I'm like, what? Where is this coming from? Why would you say that? It's like, well, it's an opportunity, And so I think that as the great COVID migration, as more people that are moving to different ecosystems, you'll see more choice. And with more choice, there's more of a market, and there's a better chance of finding that partnership fit that, like, a Bill Draper, was keen on, of saying it should really be a partnership. I like to think of myself as a junior co-founder of every company we invest in, and attempting, to be part of that. But let me ask you another question on governance. A lot of VCs take board seats or they don't take board seats. With the kind of checks you guys have historically written and stage you're investing at, there are board seats. How many board seats do you think a VC should be on as an individual? What's a right number?
I don't think there's an absolute number. I think it varies to some degree based on how that person works and the character of how their firm works. The conventional wisdom historically was that, ideal number of board seats for a VC is, 8, half a dozen, 6 to 8. I think the sort of reality, especially for VCs that were, I would say, more visible and sort of more significant, that number generally was in the mid to low teens. And today there's definitely cases where people have 20 board seats or more than that. I lived through that in the internet bubble. I had over 20 board seats at one point, and that was ridiculous. Like, there's kind of no way, with the benefit of hindsight, to really give those companies the attention that you should as a board member. That's not to say that I didn't pay attention to those companies and wasn't engaged with them. It's just an overwhelming amount of work for the person who's on the investor side if they take it seriously. But people have different capacities in terms of what they can do, and it also then has, to some degree, linkage to the kind of investments that you're making. right? If you have investments that have lots of overlapping characteristics, in some ways it's easier to have more board seats than if you're in a bunch of, a collection of random companies where the dynamics of those businesses are all very different. So, I don't like to, I said this earlier, I don't like to be predictive. I also don't like to be terribly prescriptive in things like this, because, if I said to somebody, the max number of board seats a person should have is X, and that person has, X times 2, by definition, I'm making a blanket statement that person then has to respond and be defensive against if they want to engage, or they can dismiss me as being a crackpot and having no idea. And, there is no doubt in my mind that there are plenty of people that I know that have the capacity to have more than 6 board seats or more than 8 board seats, and I'm one of them. So I think it's a lot more to do also with the kind of role that you want to have with the business, and the relationship. I'm in a number of cases where I'm a board member and I have, very significant engagement with typically the CEO and with other board members. And then I have companies where I'm not on the board and I have very deep engagement with the CEO and possibly with some of the board members. And as I've gotten older, I would say, when I started doing investing in the mid-90s, it was almost always, if you're a venture investor and you write a check, you have to have a board seat. That's how you represent your limited partners and your investment, and your own, the phrase that gets used over and over again, sort of in nauseating ways. You have a fiduciary duty to your limited partners, and as the board member, you have a fiduciary duty to the company. And it's like, okay, well, unscramble that dynamic.
Conflict of interest, is sure.
Yeah, and long term, having 30 years later, I look at it and say, you know what? If I'm a shareholder in a company, whether or not I'm a board member, I'm a shareholder. And my level of engagement as that shareholder is somewhat dependent on the size of my shareholding, what percent ownership I have. My influence has everything to do with my relationship with the then current CEO and or founders. And the governance responsibility resides with the board. And there is a set of governance dynamics that investors get with their protective provisions. And those are fairly well prescribed. So what are you trying to do? Are you trying to have control over what's going on? Or are you trying to have influence over the direction the company's going in? And for me, it's become very, very simple, which is that as long as I support the CEO, I work for her. And my job is to help her be successful. And every CEO needs something different. And if I lose confidence in the CEO, it's my job to do something about it, which does not mean fire her. It means try to get back to a place where I support her. And every CEO I'm involved with and work with makes decisions that are different than the ones I would make. And that's totally okay. The only thing I want them to do is listen to the data that I give them and consider it. If they dismiss it or decide it's wrong or didn't hear it right and decided what I said was stupid, totally fine, as long as they give me the opportunity to engage with them and provide data for them to think about, because they're the ones running the company.
When you gave the story about the founders that wanted some provisions to prevent themselves from getting fired, what you did, which was the magic, was communication. So you brought in communication of saying, tell me why this is important to you, when ordinarily I wouldn't have said fight for this in my venture deals book, talking to people about it. I think at the board level, communication again is key. If you're the CEO, communicating with all your board members and helping them understand your perspective on it. And even if you don't control the company, you might be such a good communicator around the entire board that you effectively have voting power to try to do the best thing for the company. But
let's be precise in this one case. So to use it to fill out the example you're trying to make, it wasn't that there's a provision that says I can't fire the CEO, which, by the way, generally an investor can't fire the CEO anyway. The board fires the CEO, so it depends on the composition of the board. The one specific thing that was unusual that they wanted was if investors converted their preferred to common. Mm-hmm. In the absence of a transaction that was either an IPO or a SPAC or a sale, which would be the 3 times that you'd be in a liquidity path that you convert to common, the investor lost their voting rights. So you could convert to common, but you lost your voting rights. And that was unusual to me. I could kind of think of the case that they ended up presenting to me. Like I knew it had something to do with control over the common class, but I didn't know why. Like what happened in their past that caused them to be sensitive to that one issue. And when I heard this story, I'm like, yep, totally got it. And they could have said you can't convert your preferred to common except in these situations. That would have been the same thing. And I would have had the same question, like, well, why can't I? Because in every deal, that's normally a default term. So I use that as the example. Like if this particular company got into trouble and the CEO is not being effective, and that's what my opinion was, I would have an ability as a major investor in if I was on the board as a board member to make the case to other board members and to the co-founders of the company who are also major owners of the company that the CEO wasn't being effective. I would start with the CEO, and I would not just start with the CEO and say, you're not being effective. I would say, here's what my issues are. Here's what my concerns are. Let's try to figure out how to get back to a place where, things are working. And if they're not, then, I have the chance. And by the way, if from a governance perspective, everybody I talk to says, sorry, Brad, we disagree with you. We think he's doing a great job.
Yeah.
Then I've got choices to make about what I want my involvement with the company to be.
Sure.
Right. So it's this interesting dance that, again, when everything's going fine, the dance never comes into play, ever. Because everybody's just happy that everything's going fine. It's when things go sideways or go off the rails. And, I've been involved in enough companies where things went sideways or whatever cliche you want, off the rails, or was starting to struggle. And where a change ended up generating a successful outcome. And, there's occasionally a cliche that runs around the system, which is if you have to change the leadership, it's too late.
Yeah.
And
that's what good, yeah.
I was just, sometimes that's true, but sometimes it's not true. And there are many, many examples of companies where there was a change in leadership from the founders at some point at the CEO level. And, the CEO, in hindsight, whether their ego was bruised or not, and whether they could sort of deal with the ego issues around it, would look back and say, wow, it was really a good idea that this happened because, I've got 78 million reasons why that was a good idea, or I've got 125 million reasons why that was a good idea, or I've got 10 million reasons why it was a good idea, and I didn't have to go through all the pain to get to the good idea.
Sometimes the body rejects a new organ, and the heart transplant of removing that founder passion, or sorry, not passion, but obsession,
totally
can have a negative outcome. I think if you change the CEO when things are going really well, you bring in Keith Kroc into DocuSign that was already rocking, then that'll make it even fire up better and faster. But to change the CEO when it's going bad is a tough decision. I think it's more about who can I put next to her that'll fill in the missing bits, that'll maybe solve a problem. Another thing is a lot of our LPs are normal Silicon Valley entrepreneurs or bankers and people in the industry that wrote a small check. And sometimes we create opportunities for our LPs that want to be active to meet the founders, and they can take a board seat for us and they can give it more time and attention. They're only on 3 or 4 boards. And for us, we're getting information before it's too late. So instead of saying, good news, we have a new head of sales, I'd rather get the memo of, hey, I'm worried our head of sales is leaving and it could take half the team with us. What can we do now? And getting that information is key. And if you're on 90 boards, it's hard to get that communication working, to that point. Well, like a short answer on this one, Brad, what's the point of a board meeting? And I also want to talk about, with all the convertible notes that have happened over the years at Techstars, you've probably seen companies grow quite a bit without a board of directors. And I think that's an issue. So kind of, they go together. Like, when should you start having an outside director, even if you're living in endless promissory convertible note world? And what is the point of a board meeting anyway?
Let me answer the second question first and then go to the first question. I'm a proponent of creating a board early. and creating the formalism around a board early. And it's decoupled from whether you have convertible notes or safes or priced equity rounds, because
well, that's great, but in reality, it's not, right? In reality,
I think people generally don't do it. I'm suggesting that those things are decoupled, though. So it's really the CEO and the founders being deliberate about building a structure with some formality early in the life of their company, so that they get into that rhythm. I also am a big believer that there should be balance between the best boards are ones that are balanced versus ones that are investor heavy or founder heavy. And I like boards that very quickly early on start having independent directors, not where the independent director has an independent seat for life, but where the board starts functioning as a team that is another team that the CEO gets benefit from. So, the CEO obviously is building the leadership team, and that team reports to the CEO. The CEO also has the ability to build a board team, even if they don't have control over appointing all the different directors, and putting effort into facilitating the functioning of that activity as a team. And as companies get bigger and bigger later in life, it becomes much more around the governance of the board. And around the board playing very specific roles with regard to the CEO and with regard to the company. But early on, come back to this thing I said earlier, which is that it's just another set of resources that the founders and the CEO have working for them to try to help them be successful. And there's some extraordinary venture investor board members and extraordinary independent board members who, have time and time again been extremely helpful at helping a company that's young, and especially one growing quickly, navigate a lot of different issues. So if you come back to the roles and responsibilities of the board, I separate them into two very simple buckets. One bucket is helping the CEO be successful. And again, every CEO needs something different on that dimension. So understanding that and communicating clearly amongst yourselves with the CEO and understanding that dynamic is key. And then the other is that there are a series of very specific governance related responsibilities that a board has, legally defined as things like duty of care and duty of loyalty. And those things tend to come into play whenever there's any sort of structural event around the ownership of the company, whether it's a financing or a sale. So there's typically good engagement there. There are some things that does matter in the development and growth of the company, especially as it becomes more formalized. And it's very interesting for me, the shift from companies. I'm on a board now that's going through this shift where it's just a collection of board members, and the collection of board members kind of does everything together with the CEO and the founders, to one where all of a sudden the company's big enough and the issues are getting nuanced enough where there's value in having a real audit committee, and there's value in having a real compensation committee, and different board members now are on those committees because it's actual work. Yeah. It's not just showing up and saying yes or agreeing to something, but it's doing that work and being responsible. Again, well-defined functional dynamics. That's the other category. So, and they're not mutually exclusive, by the way, right? The good boards communicate. Let's say I'm the audit committee chair of a board. I say, look, I'll cover this if Mary, if you cover the comp committee. And I'm not the only person on the audit committee, and Mary's not the only person on the comp committee, but we're kind of saying, look, I trust you. I'm not going to second guess what you're doing because you got a lot of work to do. If you have questions or you want to run stuff by me, run it by me. But I'll pay attention to my stuff. And then we can be a team in the same, and communicating again to the CEO and working with the CEO to get leverage across the knowledge and experience base we have.
Right. I mean, one question, at some point you have to ask yourself, do I enjoy what I'm doing? And if you're saying, where do we park the bicycles and, these stock options going through, like maybe there's someone who enjoys this or is better at it than me. But I want to get to some final questions, but before dropping, I'm curious with your, from the years of experience and the volume of our exit valuations rationalizing the entry point valuations for venture right now? I mean, can we explain away 180 million pre of what might have been a much lower number because we have comps in the public markets? What's your perspective on tying together these entry point of real venture, like through series A, B, and C, to are we getting out enough that this vintage is going to be the vintage you wanted to be in?
Well, this is all cause and effect and feedback loops, right? And the short answer to the question is it's unlikely that the exit values effectively rationalize the entry values because they're not tied together in time.
In time, right. Like a downturn. There's nothing like a downturn. Valuations crash, that pre-money, all of a sudden the round falls apart. You're coming in at half the pre-money. And by the time we're not day traders, by the time we exit, the market will have recovered. That's a vintage you want to be in.
Right. And so the challenge is, and it's not just tech and it's not just this cycle. I mean, you can go back and look at markets, in the 1950s and 1960s, and you look at the same kind of dynamic and you can say, well, the opportunity for tech is so much bigger. There's lots of ways to rationalize it. If you're an investor, entry point matters. And it matters based on what you're trying to get as your exit outcome. So, if you're trying to invest X and get 2X back in 12 months, and that's the strategy you have, and that's what your expectation is, that's a very different investment strategy than if you're investing in X, a bunch of things aren't going to work, and you're trying to have a couple of things that are 50X or 100X.
Yeah. And
again, everyone is good at sort of describing their own world as it is current, but it holds constant this exogenous force that you can't do anything about, which is what happens over the passage of time. It's a truism for sure that if you build a durable, enduring company that has value to customers and is able to do it in a way that generates long-term economic return, you will have increasing value in your company. It is also a truism that everybody loses sight of the last part of that equation, which is that you have to create economic return. You have to generate positive cash flow.
Yeah.
That you sort of end up in this situation. Well, as long as we're growing 100% year over year, it doesn't matter how much money we're losing until all of a sudden it does. And then if you have massive leverage on your business, which by the way, that's one of the things that's been really good about SaaS-based businesses, is that there's a lot of leverage on the growth curve relative to all of the different characteristics. So when you say, okay, I need to now start generating positive cash flow and I'm willing to give up some growth for that.
Yeah.
Or I've got a critical mass of customers and now I've created a feedback loop where I acquire more very, very high gross margin revenue at no cost from my existing customers.
Right.
Those things start to generate significant profit. The inverse of that, however, is canonically not true. If you've got a business that's a 10% gross margin business and it's growing at 200% year over year, and there's really no way to move it from a 10% gross margin business to something bigger. And for every dollar of revenue that you generate, you have to spend $1, right?
Or worse.
Or you're never going to get to a place where that business works. And you can say, well, and there's always edge case counterexamples, but look at Amazon, or but look at this, or but look at that. And the important thing there is to deconstruct what those businesses created. And I love the Jim Collins construct that he created with Good to Great, and that's often used today, this notion of a flywheel. And it's essential. Jim Collins wrote a book called the Flywheel Monograph. It's 40 pages that is just the summary of how he envisioned the flywheel. And it uses a few examples, Amazon being one of them. And you look at just the massive profit generating activity of these businesses as a result of how they linked all those things together. That's independent of what entry price you paid. And so if the company doesn't have that capability at some point, it doesn't matter what your entry point is.
Yeah.
Or if it can't execute, it doesn't matter what entry point that is. And the challenge is the pre-revenue, the pre-revenue valuations inflate. and more money gets invested in those early rounds at these higher and higher prices. When those things fail, of which many of them will, because none of those things are proven, they're still just hypotheses, that will have a negative impact in a meaningful way on people's returns.
Right. And Brad, do you have another 5 minutes left?
I'm good till keep going.
Okay. So I think it's important sometimes that when things go bad with a company, all the employees, not just the top founders, are there for some sort of mission and not just their salary and stock options. And this comes into building a culture or allowing people to self-actualize, at the place. Maybe give us this is a very different question, but give us your thoughts around how to create a culture and even how to deal with perhaps depression at the founder level or within a company. So you can kind of go anywhere you want with this kind of question.
I don't like the phrase culture because I think it's too generic and it's used to sort of take too many intellectual shortcuts. I like the phrase cultural norms better. And from my frame of reference, and the reason is it makes people slow down a little bit and understand what they're talking about. One of the wonderful and amazing things about being a founder is you get to define the cultural norms of the organization or the company you're creating. One of the cliches that existed for a long time was when you hired people, you wanted culture fit. You wanted people who fit within your culture. And I think culture fit is a phrase that should be just exterminated. It's a terrible phrase because what it does is it creates monoculture. It's anti-diversity. It doesn't actually stretch or extend your thinking. And that's one of the reasons I don't like culture, because it's separate than saying, I want people that subscribe to my cultural norms. But every time somebody joins, I want them to be culture add. I want them to extend the culture. I want them to enhance what we're doing. I want them to help us stretch as we get to be a bigger thing, to have a more robust dynamic around our business and our business culture, if you want that phrase. But we still have these norms. We have these things that we agree on. And, in 30 years ago, you might have called them precepts or principles or mission or something like that, right? But it's this notion of saying, what are our real fundamental values? And then building on those fundamental values, how can we extend and enhance them on a continual basis? I think that is very important. And you see it in large companies where it's companies that were once very small, now very large, where they go through periods of time where there's great struggle with those based on how they've either operated, how they've approached cultural norms, or how the founders have tried to either extend them or control them. And I'll give a hopefully somewhat non-controversial version of it. I could give plenty of controversial versions of it. We're living one right now with a company newly named Meta.
Right.
But that one is inflammatory. The one that I don't think is that inflammatory is Google. And very early on, they had a cultural norm, which was do no evil. And as Google got bigger and bigger, one could make the argument that there were definitely things that Google did that were evil. And there was a point in time where the do no evil, which was center on their webpage, the About Us equivalent of their webpage, just kind of disappeared. And then there were a bunch of articles written about it and a lot of people talking about analyzing it. But it wasn't necessarily that cultural norm evaporated, right? Why it was deleted unceremoniously from the website is a little curious.
Or even if it's on there because they're doing evil, like don't look behind this door. That's where we burn all the documents.
That's right. And so then what happens is as companies get bigger and bigger, it becomes very, very hard to enforce those early cultural norms. But a good, healthy company is constantly investigating and revisiting its cultural norms and re-engaging not just the founders, but the whole team across whatever those cultural norms are. And almost by definition, as companies get big, there's always lots of change. There's acquisitions, there's divestitures, there's people that quit that have been there for a long time. There's other people that are hired that have come from other places and have different cultural norms. When you talk about trying to keep people engaged, it's not that you have to be 10,000 people when this happens. When you're 50 people, when you're 100 people, you have to keep working on this stuff. And some leaders are really good at it and many leaders are not. And the ones that are less good at it often fall back on whatever their their original cultural norms are, or are unable to evolve their own view of the company. And sometimes that works and sometimes it doesn't, right? I mean, there are definitely cases where, every company I've ever invested in has had a near-death experience that was successful, has had a near-death experience. I mean, a really profound one. Every company that I've invested in have had multiple people on the leadership team who were high performers, not fit within the machinery of the company. So they were there for some period of time and they had some impact, but long-term, they didn't fit. It didn't work for them, or it didn't work for the CEO, or it didn't work for both them and the CEO, or something changed in their life. Like this is just a natural part of it. And that's why I resist the phrase culture, because it's too static and it's too mushy. And it's more you have to be constantly revisiting these things. And by the way, it's totally fine for me for a founder to say, you know what, this is so important to me that it's unchanging. I'm the CEO. This is unchanging. I refuse to change this cultural norm. That's that person's right. And then the people, around them can decide whether they subscribe to it or not. And as an investor, ultimately, and a board member, ultimately, I can decide whether or not I support the CEO and the founder. And it generates a conversation when there's more clarity and precision than when it's vague hand waving. Let's work on our culture. Yeah. People are unhappy today. There's stress on the system. Let's all go bowling and have some events and work on our culture. That's kind of the bullshit that's not interesting.
I think there's a layer of governance that's bottom up. So, I mean, you can have a board with voting rights and common, preferred to common or whatever, but it's ultimately, if people don't want to work at Facebook, like I'm single, I'm embarrassed to say I work at Facebook, that's going to have a voting right of some kind.
Of course.
So,
of course. And then you just have to decide, is the bribe on the other side worth it, right? I'm getting paid X dollars. I think the value is Y. Am I willing to subjugate my feelings to this? And that's not a judgmental statement. And I refer to it as the bribe, because I think there's lots and lots of situations where we get confused between what is compensation and what is the, people say the incentive. But it's the bribe to do a set of things that you don't want to do. It's a bribe to have a value system that's different than what you want. And that bribe could be money, it could be power, it could be recognition, it could be ego gratification, it could be free snacks, it doesn't matter, right? And you say, but that's all just culture, isn't it? And as individuals in companies and organizations, we get, especially in tech in general, not always, but in general, many people have the luxury of choice of where they work and where they spend their time. Many people don't. So I should be careful with that statement and not sound like a privileged fuck, because there's plenty of people in the tech industry that don't have that choice. But when one does have that choice, being thoughtful about what one's own norms are and whether they are colliding with the company or whether they're in support of the company becomes important. And I do have to go now.
Okay. Final question. What are you optimistic about, either in tech or society or both? And short answer is cool.
Optimistic.
That was a good answer.
It's I'm very, I'm generally a pretty happy and long-term optimistic person who's been very open about my own struggles with anxiety and depression as an adult. But I separate anxiety and depression from optimism. Like they're separate dynamics for me completely. I'm also, I don't know, I lost the word for it, but I'm an atheist, and I believe that when we die, it's over, and we turn into atoms that get distributed across the universe. And I have, as I've gotten sort of older and learned more about I would say contemporary philosophy, as well as classical philosophy, contemporary physics and quantum physics, like the mystery of existence becomes more and more profound for me. Okay. And so my optimism tends to be that if I wake up, I'm gonna then engage fully with people I wanna engage fully with through the course of my day. And I'm very comfortable that good things are going to happen and bad things are going to happen. And that there are things, many, many things that are going to impact me or exogenous and outside my control. And I'm not going to try to control all of those exogenous factors. And instead, I'm going to try to put my time and energy that's limited, finite on this, I love the phrase speck upon a speck upon a speck, right? We're this planet at the bottom of we're this little tiny thing at the bottom of a gravity well on our planet that's circling a nuclear reactor that's at the tail end of a tiny little irrelevant galaxy in an infinity of galaxies, which, oh, by the way, may not even be the correct construct for how any of this stuff works anyway, because there might be an infinite number of universes being spawned continually and whatever our constructs are wrong. And so I just zone right back into, I'm optimistic that the people I spend time with and I choose to spend time with and spend time with me are going to be interesting, stimulating. I'm optimistic that I'm going to try to continue to be a source of positive in the infrastructure of the world that I engage with. And somebody said recently to me, the meaning of life is finding love and finding happiness. And I'm trying my hardest to do both.
Brad, thank you so much. I'll respect your time. Maybe we'll do it again in a year. Thanks so much. Have a great day.
My pleasure. This was fun. Great interview.
Thanks, Brad. Bye.
All right. See you soon.